You say, welcome everybody, and welcome back to another session of our class today. So today we're going to be basically going into how to drive an edge, how to give yourself an edge in the forex markets by taking into consideration risk to reward ratio, right? So risk to reward ratio, how that gives you an edge in the markets, okay? And that's basically what I'm going to be discussing, and I'll be showing you, how it's how it's not so difficult to make money. It's not easy either, but it's not so difficult to make money if you manage your emotions and if you play the game right. Okay. Now everybody wants to make money in the forex markets. Everybody is all about, the reason most people jumped into this business is because they saw somebody online, or they saw something here, or they saw something there that says, I just bought this new Range Rover, or this new, car, or this new Rolex, or this new house from my trading profit. And everybody's like, oh, if I start trading, that means I'm going to become an overnight millionaire. Now, true, why that happens, what you also need to understand is in the forex market, in the trading, a lot of people lose money. You have to put that into factor. It's a zero-sum game, so the winners are paid by the losers. And what you want to do is you want to give yourself an edge in the market where you're part of the winners. At least you make your own share of the profit. Profit is relative, meaning you don't compare what you make to what the other person makes, because, well, at the end of the day, you don't know how much they are trading compared to you. And that's one of the mistakes most people do, is that they look at trading in terms of dollar amount. So you're like, okay, I made $10,000 last month. So you're like, wow, the guy made $10,000 last month, and I'm here. I only made $20. Now, here's what you don't ask, or what people would not ask, is how much capital is he or she trading? And then you're like, okay, maybe he's trading a $1 million account. Well, he's trading a $1 million account and he made $10,000. All of a sudden, it doesn't seem as much. But then you're trading a $100 account and you made $20. You already made 20%. On a $1 million account, $10,000 is what? Less than 1%, or about 1%. So you see that the focus should be on having a system that you can scale up. So if you have, if you understand that, okay, you have a system that you trade and you can scale up, whether you're trading a $1,000 account or a $100,000 account, you still go, it's still the same thing. It doesn't, that's why a lot of people, they're trading. They start trading on the small account, they can double the account, but then you give them a $1,000 account and they're like, they blow the account, and you're like, what's going on here? It's because there's no system behind it. You just flip the coin, place a buy. If the market boosts up and goes up, boom, you make a lot of money, and you're like, oh, that's it. Now, so in this move here, let's say on a $100 or the $200 account, you place a 0.1 pip, use a 0.1 lot size, and then the market moves this much and you make $30. That's already 30% on your account. Now, if you have a $10,000 account, you wouldn't just trade 3 lots or 5 lots or 30 lots, because, so even if you capture the same move, right, out of a $10,000 account, maybe you only make $100 or something like that. Now, you're beginning to get the point. So the point is, you need to find a way to be consistent. And the only way to do that is one of the things I always say is to have a system, right? Rule-based trading is the only way to make it in this game. That's the frank truth. Now, so what is rule-based trading? So you ask yourself, okay, so what are my rules and what do I look for to trade, to get into a positions? And these rules will keep you away from trades, right? So if let's say you only look to buy in a bullish market, and let's just assume you trade Fibonacci. You see the market making break of structures to the upside, making higher highs and higher lows, and you've established that this market is bullish and you want to look for buying opportunity. And the way you trade is that you just look to buy the 51 or the 61.8 fib retracements or stuff like that. And that's your rule. Now, what you want to do is only trade that. So what it means is there are certain times the market is not, let's say the market is here, it hasn't gotten to your area. Based on your rule, you should wait. You should not be trading, right? So having rules as to why you get into a trade and how you get out of the trade is the key to trading success. Now, once you have those rules, so rules to entry, right? So the rule number 1 would be entry criteria. What determines, why you're looking for buying opportunity or why you're looking for selling opportunity. Now, this second point would be, how do you, how do you get in, right? How do you enter the trade? So let's say you're waiting for the 61.8 fib retracement, price is there, and then you confirm. So you want to confirm. I'm going to leave confirmation a little bit out of it. You can watch some of my previous trainings on confirmation. And now, let's just assume we're buying purely from the 61.8, and our stop loss should be below the low, our target should be the highs. Well, if that's the case, then you ask yourself, well, so how then do I, what lot size do I use? How do I manage these trades, right? Now, what you want is a situation where every loss is the same. What I mean is, every time you take a loss, it should mean the same. And every time you take a win, you should be able to calculate it, right? So take this for instance. How many times have you open a trade? So if you've ever traded a live account, many people would have this experience. You open a buy trade here, okay, and then the market begins to go up like this. At the time price gets here, the way price doesn't just move up in straight line. Sometimes it will go up and then it will come down and then it will go up and then it will come down. Now from here to even here is even good. Maybe from here to here, what will happen? Most people would have closed. They would have closed they've made profit. So let's say they're using 0.1 lot size. And from here to here is 10 pips, okay? So 10 pips, 0.1, that's $10. And they've made $10, okay? Now, there's no logic behind the trade. It's just that they've seen profit, so they close. Now, here's the thing. Even if they make, so they took a buy here, the price goes up like this, they close it, and the price continues to go. They're like, man, okay? So they won one trade here, so $10. It will not even be $10. It will be random. So it might be $5, it might be $8, it might be something like that. Again, they took another trade, something like here, okay? So they made another, so let's assume they made $5 here, they made $10 here, and then let's say they make another $10 here, okay? So they've taken 3 trades, okay? And so far, you're up $25. Fine, wonderful, okay? Now, here's the thing. Let's assume they take another buy here. Okay, let's just assume they take another buy trade here because they see this candle going up and they're like, this thing is going to go to the moon. Now, guess what? No stop loss. Or maybe they'll put the stop loss here. Or maybe down here. Now, what happens if if they use stop loss, it's even good, safe. So the market does this and come down here. So what will happen is they've won 3 trades and made $25. You've won 3 trades, you made $25. But then you lost 1 trade and you've lost $40. So you've won 3, yes, but you've lost 1 and you're already in negative. You see, it does not make sense. This kind of model is not sustainable. Now, this is even for people who are wise, who are reasonable enough to use stop loss. For most people, guess what? No stop loss whatsoever. So they place a buy and they're just hoping, right? So let's say here, they place a buy, they're just hoping the price would continue to go up and the market flushes out. Now, it's either they blow the account or at some point when the loss is now too much, they'll FOMO in, they'll be scared and then they'll close the trade and maybe the market goes up or maybe it comes down and then so it doesn't matter. If it goes up, it's even worse. So if it goes up like this and they're like, I should have held on to this trade. I should have held on to this trade. Well, that kind of thinking is how accounts get blown, because guess what? They'll still keep thinking, well, I should have held on to this trade. I should have held on to this trade. And what will happen is, something like this. Somebody will see something like this. The market is bullish. Let's say they buy here. The market goes down. No stop loss. Maybe they even add more buy position, add another buy position, hoping that price wants to go up, that, this thing has to go up. Then they see price begin to do this and they add another buy position. And what happens is it flushes out. And by this point, your account is blown. Okay. Now, the truth is, these same persons might have taken like within this area here, might have taken like 200 trades, right? Let's not say 200. Let's just say they've taken like 12 trades or 10 trades. And those 10 trades, they probably won them. So they took a buy here, they closed it. They took another buy, they made $5. They took another buy, they made $2. They took another buy, they made $15, So they're just making So let's say the account size was $200, and now by the time price is here, maybe the account is now, let's just say 250. Okay, so they've made 25% on the account. Now they take another buy, hoping it's business as usual. And what happened in this case? Well, it doesn't go up, it begins to fail. Now, instead of taking, because there's no risk, approach to the trading, what happens is, well, one loss, so 12 wins would be wiped away by one loss, right? And what happens is it won't just wipe away the win, it probably wipe into the capital. And before you know, the entire 200, basically the 250 is blown. Now, if what I'm saying makes sense to you, type in a yes. If what I'm saying right now makes sense to you, type in a yes in the chat box. But this is the reason, in my opinion, why most traders lose. Because the focus is not on system, but on basically is on the money, is on the dollar value, right? And this is why, so you make profits, you take 10 wins, and then you make one loss, and one loss wipes away 10 wins. And you're like, it's like you're taking 2 steps forward and then you take 5 steps backward. You take 2 steps forward and you take another 5 steps backward. And this is how accounts get lost. But losses are not a bad thing. If there's anything you take away from this training today from me, is that you should love your losses. I know it sounds ironic, but you want to love taking losses. Now think about it, right? In any business, there are losses. In any business that you do, irrespective, there are losses. And you don't throw the business away because you lost something. Let's say somebody who, if you're into you buy and sell, sometimes you pay for a goods before the goods come, some of them are damaged, or there's something with, in the logistics, you don't get it. There risk is the reason we have insurance, right? And this risk, they're not terrible. They're just part of this. If you don't want any risk, you just sit in your house, right? If you don't like risk, you don't want to take any risk whatsoever, don't step out of your house. Because if you step out of your house, if you're not, you probably are driving, if you're driving, if you don't hit somebody can hit you, right? God forbid. But it's the fact. If you're not driving, you probably have to enter public transport. You don't know if the driver is feeling fine, if his girlfriend just broke his heart, or if another useless person is driving on the other side. You don't know what happened, but we pray for the best. But we understand that every time you do something, there's risk. Have you watched any of these nutritional specialists? They'll tell you, don't eat this, don't eat this, don't eat this. If you eat this, it's bad for that. You ask yourself, so at the end of the day, what am I supposed to eat? So risk is not a bad thing. So if you take anything from this training, is the fact that you should love your losses and you should take them gladly. Meaning you want to, and the only way that you get to the point where you're taking your losses gladly is if you have confidence in your system. And how do you have confidence in your system? This is where journaling comes in, right? So journaling is very important. Journaling it's very simple, but it's also very important. You can just pull out a spreadsheet, put in the instrument I trade, instruments. You can have several columns where on one hand you have the pairs, right? And then you have the entry price, stop loss, take profit, and you ask yourself, did I win it or not? Okay, so you take record of your trades, right? And then you have a system. So if you're trading a particular system, backtest it enough and have confidence in that system. Such that, so let's say you have a system, you're trading the moving average crossover. That means if the moving average crossover themselves, you open a buy or a sell depending on how the crossover occurs. And then after backtesting over, so simple backtesting is you just scroll back in chart and look at what you would have done if you're simply following your system. And you ask yourself, out of 10 trades, how many is one? Or you say, obviously, the larger the data size, the better. So if you take 10,000 trades on a particular system, or 1,000 trades on a particular system, you would find profitability. But you have to just look at it from that system, because then you have to, so let's say you take 1,000 trades, so 1,000 trades, right? And out of the 1,000 trades, you only win, let's say 40%. So that means out of 10 trades, you win 4, and then you lose 6, right? Now, let's make it even. Let's say you win 50-50, right? So you win 50 out of 100. That's 500 out of 1,000, and that's 5 out of 10. So out of every 10 trades, you win 5. Now let's say if for every trade that you win, for every trade that you lose, you only lose 1%, right? So this is where risk to reward comes in. So for every time you take a loss, your risk is 1%. Now the reason is in percentage is because, well, it is the same across board. 1% is 1%, whether it's $1,000 account or $100 account or $10,000 account. The value would differ, but it's the same percentage, right? So 1% on $1,000 would be $10, right? 1% on $10,000 would be $1,000, right? Or it will be $100, sorry. 1% on $100,000 would be $1,000. 1% on $100 would be $1, okay? So now, if you risk a specific amount per trade, then you know that every time you take a loss, you're only losing a specific amount. So anytime you take a trade, you already know what your risk is. I always tend to say something. Before you place any trade, the most important parameter to you should be, where is my stop loss? Where is my stop loss going to be? Once you define where your stop loss is, then you can determine what lot size you would use. Many of you here who trade would know that most people don't calculate lot size. So they just know, oh, my account size is $1,000. I'll use 0.1. Now, you take a trade from here, right? So you take a trade from here, you buy, and your stop loss is down here. And the difference between from your entry price to your stop loss is 50 pips. And you use 0.1, okay? So if you use 0.1, let's say your account size is $200. If you use 0.1 and your risk is 50 pips, right? That means if you're wrong, you lose $50. You ask yourself, am I comfortable losing $50 on this $200 account? If you're not comfortable losing $50, then it means this risk is too much. You need to ask yourself, what is comfortable, right? And if you're not comfortable with taking any risk at all, then you should not be trading, okay? Now usually I would say 1%. I don't risk more than 1% of my account on any trade. That's the way I trade, right? Now, obviously, you might vary a little bit for yourself. So you might say 2% for, those of you people with smaller accounts or stuff like that. So somebody who's trading the $100 account, 1% is is $10. Sorry, 1% is $1. So you factor in all of those to yourself, okay? Now, if for every trade you're risking 1% and you're going after 1%, let's make it simple for now. So you're risking 1%, right? And your reward, so this would risk, so this is reward, is also potential 1%. If you win 50 trades out of 100 or 5 trades out of 10, at the end of the day, you'll be at you'd be at break even, right? So you would lose 5, which would be minus 5%, but then you will win 5, which would be plus 5%. Okay. So at the end of the day, minus 5 plus 5 is still be where you are. So your account has not moved. Now, but think about this. Note that right now, we're not going to, we're not looking at this and we're saying, well, this means that it's one of two ways. The way to be profitable is either you win more, right? That means out of 10 trades, imagine if still the same thing, but out of 10 trades, you win 7. So plus 7 to my drawing. Okay, so let's say you win 7, so that will be plus 7, and then you lose 3, which would be minus 3, right? So what this means is, well, out of 10 trades, or your win rate is, in this particular case now, is 70%. Okay, you would be up by 2%. That means you would have grown your account size by 2%. So you can the way to be profitable is either you increase your win rates, right? Which is one way to do it, but this is not the way I'll go about it. The way I go about it is to increase my risk to reward, what I call RR, right? Now, imagine if, let's go back here. Let's go back to, we win 5 and we lose 5. So, 50-50, right? Imagine that anytime I'm wrong, I lose 1%. But anytime I'm right, I gain 2%. 2%. Now, if I lose 5 trades, well, that's still minus 5%. However, if I win 5 trades out of the 10, for every trade I make 2%, that means if I win 5 times, I've made what? 10%. So I would have increased my account by 10%, but my 5 losses will give me a negative 5%. Note now that, yes, I've lost 5, I've won 5, but I'm up by what? 5%. Now imagine if you are trading $10,000 account, right? Or $1,000 account. So you have $1,000 account and you grow your account by 5%. 5% of $1,000 is how many? Quickly, I know the answer. I just want you guys I want it to be a little bit interactive. What is 5% of 1,000? Who are the people who did math in school? 5% of 1,000? Are you using your calculator? It should be $50, right? So basically, so you made $50. So let's assume, okay, so the answers are coming in. Yeah, 50. Okay, good. Now, so essentially, you've made $50 on your account. Now let's assume, so this is on 10 trade. That means you take 10 trades for the week, right? You have $1,000. So let me clear up this a little bit so that we can see, have more room to work with. Okay. Now, let me do this as well. Let's just use a blank space. Okay. Now, you on the first week, from Monday to Friday, you took a total of 10 trades, right? Out of those 10 trades, you won 5, right? So 5 wins and 5 losses. Okay. Now you're up by 5%. Right? Now imagine, remember the first guy I spoke about, who takes, open a trade, close for profit, open a trade, close for profit, open a trade, close for profit, open a trade, and the market goes down, and there's no, and then you blew the account. So this particular person might win, this same person might take 10 trades, right? Wins 9. So 9 wins, 1 loss. You added 5% to your balance, to your equity. So your $1,000 is now 1,050. So you made $50 that you can withdraw and go and buy shoe. This person won 9 out of 10 trades, but lost 1. But this person has blown the account. They are now at a balance of $0. Can you see the difference, right? Because one person is focusing on risk. One person is focusing on risk management, while the other is just focusing on profit gain. If you watch this, I think it's Ray Dalio or Warren Buffett says something about, if you watch the bottom line close enough, the upside will take care of itself, right? So your focus should be on consistently finding an edge in the market as opposed to looking for the dollar. Okay. Now, if you find an edge, just like if you're doing business, right? So let's assume you're in the business of providing services. So let's say you own a restaurant and you sell food. Sure, the reason you open this restaurant is so that you can, one of the goals would be to make money from the restaurant, right? But imagine that you now solely focus on making money. That's all you want to do. So you don't care about any other thing. You don't care about customer service. You don't care about cleanliness. All you just do is you buy the food, okay? You buy it for $1 and you want to sell it for $50 or, $100. Well, if you manage to sell 1 or 2, you make some money. But the point is, well, if you don't take care of your customers, they will not come back. If you don't, you have a competitive price, you would not sell. So everything comes into play. You don't just say, oh, because I want to make money, if since I bought this for $100, I'm going to sell it for 1,000. Because you would not sell it. So in the same way, yes, we all want to make money from trading, but if you focus on making the money, you're most likely going to lose it. So what you want to focus on is finding your edge and finding consistency by doing the maths, right? It's quite simple. Now, notice I'm not teaching you any specific system or trading style, right? Because it can work on any system. You just need to do the test long enough. So by test, I mean you need to have documentation, which is what's called journaling. You need to journal your trades. You need to record your trades and you basically calculate what you do and have a system. So first thing, you should have a system, a style of trading, what you look for to get into trades, and then you want to stick to it. And then you want to journal your trades, not just live trade. You can just go back and check yourself, okay, how would I have traded this based on my system? And do it over and over again. By the time you've taken 1,000 different samples, you would find out you definitely find out what you're doing wrong or what you can do better. Okay, so now let's take what we've learned now, and let's just quickly, it seems like this is supposed to be a forex class, but we're just talking maths. But let's see what it would probably look like on basically on if we had a system that we're looking to trade. Okay, so let's do this. Okay. Now, so I'll come back to this. Today I already taken 2 trades on GU. Okay, so I had 1 trade here. Okay, right. I had 1 trade here, which took me out for a loss, and I'm currently in another trade. Okay, now think about this. I bought here. See where my stop loss is, right? Now I have my own specific system for trading. But for most people, if they take a loss here like this and they see the market go up, they'll be like, I should not have kept my stop loss here, or I should not have used stop loss. See how the market came, took me out, and went my way. Now, that's not my business. The point for me is, if the market meets my rules for entry, right, and everything is aligned, I will take the trade. And I have my rules for exit as well. So somebody will have, you shouldn't have closed this trade. You see, you'd have been in profits. But taking my loss here is good. Okay, so I'll come back to this in a bit. Okay, now let's quickly let's just quickly think of a simple system, one that I can, that we can just use and back test, okay, just for this same purpose. Okay, now we're going to be looking for pin bar or engulfing candle. We're just going to create a simple pin bar or bullish pin bar or engulfing candle. Now, the simple system would be, well, we want to determine market direction. So if we see that the market is making higher highs and higher lows, right? Higher highs and higher lows, what we want to do is, if we have spot market direction, right, and we've seen that it's bullish, we want to look for bullish pin bar and bullish engulfing candles. However, we're not going to look for them everywhere. What we want to do is we want to wait for when price is retracing, right? So if market is retracing, we want to look for those setups. So I'll show you what I mean in a bit. Okay, but I hope, does everybody, most of you at least, for the people who have some idea behind with regards to trading, do you understand what I just said, right? Remember, the goal of what I'm showing you now is just to show you that you can apply this setup. You can have this, the idea behind having defined risk management and using a defined risk for your trade and accepting your loss would give you an edge in the markets. Now I don't have to use GU. Anybody wants me to use any specific pair, you can just type it in and I'll use it. I'll show you, it doesn't matter. We're just going to, look at price for a period of time, determine market direction, and then look for trade opportunities that we may have taken. Okay, so simple. Now and basically we can look for this on any time frame. So let me just quickly go to okay, let me use a fresh chart. Okay, let me use a fresh chart. JBP USD. Oh, okay. Well, let's why is it not typing? Okay. So let's just use a fresh chart. Okay, good. Okay. Now we can delete all drawings. Yeah. Now, this is a 1 hour chart. You can apply, but you know, it doesn't matter, right? Now, I'm just going to ask simple question. What is price doing? So obviously, in one of my previous trainings, I talk about how to understand market structure, how to, how we look to see if we're now bullish or bearish and all of those things. But I'm just going to switch quickly, just drawing the, what I'll probably be looking for and how to trade it. Okay, so very simply, let me just quickly look from here. So here, market is bearish, making lower lows and lower highs. Okay, so bearish market making lower lows and lower highs. And then, lower lows and lower highs, it's still the same thing here. I just skipped all of them. I came to the end. And then price began to break up, okay? Making, made a higher high and then started making higher lows and higher. So basically, in this particular market here, we went from being bearish, right? We went from being bearish like so to now becoming bullish, shifting back a little bearish, and then pushing back bullish, okay? So simply, we ask ourselves, what is price doing? And you can see what price is doing simply by looking at charts. Now, easy to make it easier, the higher time frame will probably give you perspective, okay? So the higher time frame, you probably get a clearer perspective as to what the market itself exactly is doing. So let's jump back down to the lower time frame because we'll be able to spot more trades opportunities. Okay, so remember, we are looking to trade just simply pin bars and engulfing candles. Okay. Now, let's assume we're looking for buying opportunities only, right? We're only looking for buying opportunities because we are assuming the price is now bullish, right? So we say price went from this high to this low, and price now broke out of this high. So we have a break of structure here. So this is now our low, right, to our high. Now, based on our rules, what we want to do is we want to look for buying opportunity. And the reason we want to look for buying opportunity within the 50.0, when the Fibonacci retracement gets within 50.0 to like 0 to 100%, okay? Now, if that's the case, right, within that area there, we want to watch for candlestick formation. So in this case, we're just keeping it very simple, right? Now, the reason I'm using this very basic trading idea or basic concept to show you that you can still apply it to anything. But yeah, it might be profitable with other systems, but if you have an edge, you can trade profitably, okay? So what we'll do now is we'll identify so this would be so let me just change this and use highlighter. So this would be our low, okay? And this would be our high. Now, at this point, what we want to do now is draw our fib retracement, right? From low to high, right? So anything between 50%, or if price retrace down towards 50% retracement, we can now begin to look for buying opportunities, as long as it does not close below this low here, okay? I hope that makes sense. Now, what are we looking for? We say we're only looking for one of two things, either a bullish pin bar, right? Or a bullish engulfing candlestick. So we know a bullish pin bar is basically a candle that looks something like this, right? It might have wick, but it's not that much. And a bullish engulfing candle is basically a two-candle setup where you might have a bearish candle, right? Followed by a bullish candle that completely engulfs it, okay? That closes above the high, like this, okay? So this is an engulfing candle, and this is the pin bar, okay? Now, go back to charts. So price is now retracing, and all we're looking for is pin bar setup from within the 50% retracements. Now we ask ourselves, right? Everybody's following. Now, at this point, we ask ourselves, so see what price is doing. Is there a pin bar? Is there an engulfing bar? Now, this would be a pin bar, right? Right, that's a pin bar. And this one now here is an engulfing candle. But let's begin with the pin bar, okay? But this is a pin bar, is it not so? Now, how do we trade it? If we get into a trade, let's say the pin bar, for instance, we'll enter once the pin bar is formed, not when it's forming. And I will keep our stop loss, let's say 2 to 5 pips below the low, okay? And then we'll go after 2 RR. So 2RR stands for 2 risk to reward. So if from my entry price to my stop loss is 10 pips, okay, that means my target would be 20 pips. Does that make sense, everybody? Quickly, I want a response from you guys. Okay. So does it make sense? Is everybody following? Quickly. So I can continue. Are we all following? Okay, so I'm getting some yes. Okay, good. So remember, the idea I'm teaching you is not necessarily about the trading strategy, it's about the risk to reward. Now, this strategy, you can also go and test it for yourself, which is fine, and you can find profitability with it as well, but you have to do the work, so you have to back test it. So with spot the pin bar, it is, so first of all, we've identified the market trend, one check, price is now within the area, 50% where we are okay buying from, check. And now, remember, did we buy immediately price touch here? No. Did we buy here? No. Did we buy here? No. Did we buy here? No. Why did we buy here? Because it meets our entry criteria, check. So we have all of this aligned. And what do? Well, how do we say we'll trade it? Immediately this candle close, we open a buy. Our stop loss would be below the low. Our take profit would be 2 times our risk. So let's see what we would have done. Okay. So here, and now we're going to assume, okay, so let me quickly do this. So we're starting, let me type like so. So let's call it starting balance. Our starting balance would be $1,000. Okay. Okay, so we're starting with $1,000 account size. Okay. Now, rules are met, our conditions is intact. We open a buy at the close of that candle. Our stop loss is where? Below this low. Okay. So let's say this is 2 or 5 pips below, and our target is 2 times. I don't know if everybody can see this clearly. So because I'm using trading view, you can see, so it's showing you risk to reward ratio. So right now it's 4RR, okay? So 2 times our risk would be like this, something like this. Let me expand this a little bit so that everybody should be able to see it. Okay, so this is our trade, right? This is simply our trade. The condition is met, we place a trade, right? So we've taken our first trade. And then what happens is price begins to move. In this particular instance, price begins to move our way. And now let me see how much lot size I would probably use. So this is 9.1 pip, right? So we're risking, let's just call it 10 pips, right? So let's just assume it's 10 pips. So we're risking 10 pips going after 20 pips, okay? And on a $1,000 account, we'll probably need to use 0.1, because if we lose $10, if we lose 10 pips on 0.1, that gives us $10. So that's fine. So we use 0.1. Now in this particular case, we make profits and we make 2%, right? So we risk 1% with potential to make 2%. In this case, we made profits. So we've added plus 2% to our account. So what I'm just going to simply do here is just add plus 2, okay? Plus 2%. Okay, now we continue to, we keep on going. So in this particular, at this point, note that we've taken profits away from the market. We're out. So our account size is now, what's our account size? It's no longer $10. It's now 10.20. Okay, let me leave that the way it is and just put, so after the first trade, we now have 10.20, okay? So we keep on moving. Now, remember, we're out of this trade. Now, let's assume, I want to take this trade just for the sole purpose of showing you an example, right? But it doesn't meet our criteria because price has already moved away from our entry. Now you can have your own rules based on the way you set it, but let's just say we only take above the area. Okay, so let's not do anything here. So we keep on moving. So let me zoom out a little so everybody can see where we are. Okay, and our price begins to pull back down into our area. So we ask ourselves, is this a pin bar? No. Is it an engulfing bar? No. So we keep on moving. This here is an engulfing candle, but it's away from 50%, so we're not taking it. Okay. And then price continues moving. We ask ourselves, is this a pin bar? No, that doesn't look like a pin bar. This one, no, it's not. At least it's not a bullish pin bar because we're looking for bullish pin bar. This is a bearish pin bar. This one will go, well, yes, probably looks like a pin bar. It's a pin bar. The body is small. The wick is longer. It's 2 times size of the body, and the tip is also small. So this is another bullish pin bar. Not so. Okay. So what do? It meets our criteria. We place another trade here at the close of that candle. Our stop loss here, that's let's say 4 or 5 pips or 2 pips below, depending on whatever you do. And our target is 1:2. Simple. In this particular instance, fortunately as well, we also make profits because price went from our entry and went to our target. Now, note that here, note what's going on here. If we're using through RR, right? So now we started with $1,000. Now we have 1,020. 1% of 1,020 is no longer $10. It's now like $12 or something like that. Not 12, but something like just slightly higher than 10. But let's assume that we're just still using based on the 10. Okay. Now we've made another $20 on this trade. Okay. I just want to get to the point where we make a loss. So 10.40, that's what our account size has been increased. So we've taken 2 trades. Notice here that we made profits here, but the market did not run away. Okay, same thing here. Okay, now price is still within our area. We're still watching. Is there a bullish engulfing candle? Okay, so there's no bullish candle, there's no bullish pin bar, or this is a bullish pin bar. Okay, this one would also give us profits, but I don't want to take it. Let's just assume that we're not taking that, because even if we are to take this one, we'll still probably make profits because it will look like this. Stop loss would be below here. This is already 1:2. I don't know if you guys can see this. Let's say it should be, especially if you're watching on your mobile phone. But let's assume we're not taking this. I want to see, I want to get to the point where we take a loss. Okay, so I think I've found one. So okay, let's actually take that trade because we want to follow our rules. Okay, so we've made another 2%, and this is now. Let me copy this. So there's just about 3. This would be our account size would have increased to 10,060. Okay, so after 3 trades we're up, and then again we have this one. Now this is a bullish engulfing candle, is it not? Because we have a bearish candle, it is completely engulfed by this one. Is that not true? It is. Okay, now so what do? We take another trade. So at the close of this candle, we place a trade, our stop loss below this low here, and our take profit would be 2 times our risk. So this is where our take profit should be. Okay, now this is good because this one does not go to profit. So we made, we took a loss in this particular one here, which is beautiful. So now what we have is, how many percent are we losing? Well, we're just losing -1%. So going by this example, let's just say we lost, we've now lost -$10. So it's now 50. Okay. Now, you see what happened? Notice that, look at the size of this loss in terms of pip value, right? This is much bigger. It's much bigger than these two combined self. But the exact amounts that we're losing, because we're considering it in percentage, right? We're more focused on the lot size we use is based on our risk. We're only losing the same value. So now imagine this whole size here is, right, is 50 pips. Let's assume this movement here is 50 pips. On this particular trade here, we used 0.1 lot because it was 10 pips. Would we still use 10 pips, 0.1 lot here? Well, the answer is no, because if we use 10 pips, if we lose the trade, we'll lose $50. And $50 is more than 1%. So we ask ourselves, what lot size do I need to use such that if I'm wrong and I lose this trade, it would not exceed 1%? Now, sometimes you would have to use lot size that is less. You know, that means you'll be risking less than 1%, or which is better, okay? So therefore, what happens is, what lot size do I use? Well, if I use 0.1, I lose $50. If I use 0.05, I'll lose $25. If I use 0.03 or 0.2, I'll lose what? About $10. So that means in this particular trade here, the lot size that I would use would be something like either 0.02 or 0.03. One of them should be around or equal to $10. So 0.02 lots. So if I'm wrong, I'll still make that same. If I'm wrong, I'll still lose that same 1%. And if I'm right, I'll still make that same 2%. Do you see how it begins to make sense? Now, even though this specific loss is bigger in terms of pips than even these two trades combined, I've made more money in this trade than I've lost in this one. Does it make sense? Is it making sense to you guys? Anybody? Does it make sense? Okay, so let's just keep going, just do a few more examples, and then, we'll call it a wrap, and I'll, come and tend to some of your questions. So we ask ourselves, is our rule still met? Well, yes. So we keep going, right? We keep going. Is there a pin bar? I don't see anyone. Okay, let's take this. Okay, now because I'm not looking to break down the strategy, but let's assume we're taking this. So here we take another loss. So we take another 1%, minus 1%, which is fine. So it will reduce to 10,040, which is okay. I want us to take as much loss as possible, so that you see the maths play out. So 10,040. We ask ourselves, is there a bullish pin bar? Remember, this is this line here. Below here is where we're looking to sell. Okay. So below here, we're still looking for to buy. I mean, okay. So is there a trade here? I think I see a pin bar here, so we take a buy, and we also make another loss because it does not get to 2%. It not gets to 2 RR, so another -1. So now we are now down to, so after 6 trades, okay, trade number 6, we're now down to, sorry, what did I do? So we're now down to 1,030. Okay. And then we keep going. There's also another trade here. So this one now here is a bullish engulfing, is it not? Okay, so we take that trade too. So we take this trade here, bullish engulfing. This one also becomes a loss. Good, wonderful. Okay, so we make another -1. Takes us down to, so after 7 trades, right? After 7 trades, we are down, we are actually still up $20. Now, look at what is interesting. We've lost 1, 2, 3, 4. We've only won 1, 2, 3, but we're up by $20. We're up by 2%. Right? Now, there's also another pin bar here, which this one obviously gives us profits. And if we do this like so, this is already 1:2. somewhere like here, and this would be a plus 2%. So now we're back up to after 8 trades, right? After 8 trades, we are now back up to 1,040. Right? And then you can keep going. There's another, you know, there is a loss here. I'm not going to keep writing it out because but you get the idea. So there's a loss here. Okay. Is it even a loss? I don't even think. I think so though. It's not up to 2%, so it's a loss. That will be like a negative 1%. And then there is another trade here. This is a bullish engulfing candle. Okay. And this is, yeah, this one is a win. So I don't think price ever came back there. So this is a win, yeah. And that is positive 2. So how many trades are we taking? 1, 2, 3, 4, 5. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 trades within this area here. We've lost how many? 1, 2, 3, 4, 5. So we've lost 5. We've lost minus 5%. We've won 5. 1, 2, 3, 4, 3. 1, 2, 3, 4, 5. But each time we win, we make 2%. So we've made 10. So at the end of the day, we are up by 5%. Right? Now, here is where it gets even a little bit interesting. I can, if you have a system that, even though it might lose more, you might lose more, but with a high win rate, you can, it might be augmented. So let's say I have a trading system where I lose 7 trades out of 10. That means I only win 3. Okay. So let's say I lose 7 out of 10 and I only win 3. You can't be profitable with that kind of system if you have a high risk to reward ratio. So here, let's say for every trade we risk, every trade we win, we lose 1%, quite all right. But anytime we win, we make 8%. So we're going after 1:8, 1:8, 1:8 at every single time. So here's what will happen in this particular case here. This is not up to 1:8, so this will be a loss. Okay, this here would be a loss. This too would be a loss. Obviously, this one will be a loss. This one is still a loss. This one is a loss. This is a loss. But then this would be a win. Okay, because it's up to 1:8. And then possibly this two here would be a win. Let's see, does it get to 1:8 or does it come back to take it out? Okay, I think this one would also be a loss. Okay, so this would be a loss as well because it didn't get to 1:8. And something like this. So this is a bullish engulfing here. Okay. And this will definitely be up to 1:8 because you can see price never came back down to the stop loss. So note now that out of this 10 trades we took here, we only won 1. So out of 11 trades in total, we won 2, right? 11 trades taken, we won only 2 and lost 9. So out of the 9 loss, that gives us a negative 9%. But then this one win is plus 8%. This second win here is another 8%. So 8 plus 8 is what? 16. 16 minus 9 gives you what? How many? Do you see the idea now? So this one now makes us even more money than this one would. Yes, we lost 9 out of 11 trades taken. Only 1, 2. From the 9 trade loss, that's negative 9, so minus 9% from our capital. But from the 2 trade won, plus 16% gain, right? And that gives us an extra, basically 5% on our capital. Now, you see the idea, where you're now happy to take losses because you know that, yeah, losses will come. They're part of the game. but they're just, you're taking the losses so that you get your big win. But imagine holding on to a loss and having that loss tie down all your capital. Even though it's, many people, this happens to them. Okay, so they take a trade, okay, and the market, they're trying to buy, and the market just keeps going down, and they are sweating. For weeks, this market has been down, sweating. Eventually, the market now comes up. Do you know what happens the moment price comes back? So they close the trade at break even, or maybe slightly above break even. By the time you add swaps and commission, they're probably still at a loss, and they're happy that they did not make a loss. Now, here is the stupidity to this kind of thing, is that, one, all of these times you're waiting, holding on this drawdown, praying that God will help you, of which he doesn't listen. God doesn't listen to prayers with regards to trading, because while you're praying that price should go up, somebody else is praying that price should come down. Who should God answer? So at the end of the day, right, you've wasted both time and you've not even made anything. But if you've taken the loss, so you enter a trade and you're out of your exit trade, you might spot a better opportunity. Maybe you now see that, oh, this market is not good, it's not profitable. Maybe you jump to look at another pair or something like that, and you're able to put your capital to good use. So it's very, very important. Like, one of the most important aspects of trading is actually down to our entry, our risk to reward, and how we refine our edge for ourselves. Okay. So that's how we come to the end of our session for today. I hope everybody enjoyed the class. If you, if you do, please just leave a like, leave a comment. Let me know what you think. And remember, there are lots of classes like this that you can take advantage of with regards to, from many of my trainings and some of the courses which you can get access to all the time. Okay, so I hope you guys enjoyed the class, and yeah, I'm looking forward to having you in the next one.